Give it up today. Trump's tariffs kick off tomorrow. What happens next? Where Goldman Sachs says to invest? The bearish signal from Nvidia? Are we going to get a recession this year? The latest on inflation and how I'm planning to profit from this volatility. It's been a monster week, guys. Let's go. And welcome back, everybody. You probably just heard the news. Trump's tariffs are indeed going into effect starting tomorrow, Saturday, 1st of February. They weren't a bluff after all. The White House is going to slap a 25% tariff on Canada and Mexico and 10% on China. And this could be just the beginning. With Trump citing illegal fentanyl that they have sourced and allowed to be distributed throughout the country, which is a legitimate concern. Hundreds of thousands of Americans overdosing on fentanyl every year. Plenty of evidence to show that it is coming through those three countries, especially being manufactured by China, sent to Mexico, then smuggled into the States. That's the real epidemic. However, Trump also pointed to massive trade deficits with those countries, which means America buys more from those countries than what they sell to them. So they do indeed have quite a bit of leverage there. However, this is still likely first moves as part of ongoing and overall negotiation. And so markets and investors are wondering, what does that mean? What happens next? No doubt we've got a bit of uncertainty in the markets that is causing a bit of a spike in volatility as markets digest these unknowns. This stage doesn't look like oil is going to be a part of it, as the states do buy large amounts of oil from Canada. Obviously wants to keep the price of oil low, but he also said European Union is absolutely next. So we very well could be moving towards global tariffs coming from the States. And on the back of that, Goldman Sachs saying oil and gold could be places investors could seek shelter in, potentially shield their portfolios from tail risk scenarios if this really gets out of control. And there's a look at crude futures, 5-minute chart late this afternoon trading. Was already finding support midday, then it spiked up on confirmation we are getting those tariffs coming through. And stocks had already sniffed it out a few hours earlier. Started selling off after lunch, with markets finishing modestly down today. However, it was interesting because some of these tariff-affected stocks, like General Motors, actually held up, pretty much finished flat on the day, actually doing better than the market. Same with others like Ford, didn't sell off too much, actually recovered from earlier in the afternoon. Others like Canadian National Railway and Canadian Pacific as well, pretty much ended the day flat. So there wasn't a really huge scare across these tariff-related stocks. But just going back down to a 5-minute chart, looking at some currency pairs. The loonie did weaken on the back of this news. You can see that with the US dollar rallying up around the same time. And just going out to the monthly chart on the US dollar versus Canadian dollar, that's getting up to multi-decade highs. And just going back down to the 5-minute chart on the dollar versus the peso, also strengthened in trading this afternoon and out on a monthly chart. Still not quite near those 2020 highs, but like many currencies around the world, the dollar has strengthened over the last year. And so anybody that had been looking to buy electronics or other commonly imported items, hope you bought the dip on Cyber Week, Boxing Day or New Year sales, as they could be about to get a bit more expensive, with a bunch of retailers loading inventory going into that as well. And so with that tariff news, we're getting a bit of what we've been forecasting, a spike in volatility throughout Q1 here. And no doubt we're going to get more throughout the Trump presidency. He might also make volatility great again. But for sure, here and now, market will have to digest throughout all this. And considering the week we've had, starting off with DeepSeek, the Fed, inflation, mega cap tech earnings, been a pretty busy week. Volatility finishing at 16.4 is actually a pretty good result. After we did get a little bit of a spike there this afternoon above 17, it wouldn't have been all that surprising to see it go 18, 19, maybe even a little higher. Given we are heading into a bit of an unknown period, potential global tariffs, something we haven't seen for quite some time. But I believe the underlying fundamentals of the economy, corporate earnings, and the forward outlook is still holding up. The whole market doesn't rely on the outcome of tariff, nor does it run on top of the yen carry trade. A lot of traders can get carried away with the narrative of the day and forget what actually drives the stock market. So I was actually taking advantage of that spike in the volatility this afternoon and sold the 20 strike puts on Intel that are expiring next Friday. And so let me give you my thesis for this trade. And just keep in mind, this is just one of many trades I have going on. And so first off, with that spike in volatility and everything that's been happening in Intel stock lately, puts are pretty juicy. Applied volatility is around 50% there, with a lot of activity in the options is my first reason. And second, even though Intel beat on their earnings expectations yesterday, they did guide down for Q1, which again, it wouldn't have been surprising if the market really gapped down off the back of that. However, the stock didn't, actually held up on a little bit of a hammer formation there yesterday, and that can technically be a good sign in the market when a stock holds up on bad news. Like I said, they gave weak guidance. But stepping out a bit further, I believe they have a structural tailwind. Being a US domestic chip manufacturer and with a strong political will to reshore chip production, they're already building fab plants in Arizona and Ohio, likely to get more government contracts and backing like they have done from the Chips Production Act that could revive this once American giant as a nationally important strategic asset. And on top of that, we've got a potential near-term catalyst going forward for the stock as well. And that could be the announcement of a new CEO, which the board is currently looking for. And so typically when companies choose a new CEO, and if it's someone with a good reputation, track record of success, the stock can often rally on the back of that news. And so like I said, I sold the 20 strike puts as a cash secured put, meaning I've got the margin in my account. I'm happy to get the stock put into my account if it closes below $20 this time next week when the weekly option expires. Either way, I'll keep the premium that I wrote on it and I'll keep riding on it until I do get the stock put into my account. And then my plan for the trade going forward is when we get news of a new CEO, I'm expecting the stock to gap up, and that's when I'll write some covered calls on the stock, most likely at a 23 or 24 strike with about a month or two to expiry. And so that's effectively the wheel strategy. Write a put to get into the stock and write a call to get out. And again, I'll be happy to have the stock called away from my account at $23, $24. And again, either way, I'll keep the premium. And so as my regular viewers know, I've always said the only edge in trading options for retail traders is in cash secured puts and covered calls, or simply selling options on stocks. You don't mind buying and selling at certain prices, as buying options is a net negative for most traders. Most traders are just gambling with options, going into earnings. Buying anything out of the money, that's all negative edge. And so this is a good stock for the wheel strategy. And stick with me today because I'll also let you know another stock I did the same thing on today. Anytime we get spikes in volatility, I shop around for some puts to sell. And so if you're into trading stocks and options in general, then make sure to subscribe to this channel, as I make these videos every day a few hours after close, keep you up to date on everything important happening, and I'll also let you know some trades I'm taking as well, as my goal is to help you make better trading decisions. And as always, a huge shout out to my loyal daily viewers for hitting that like button and helping to support this channel. I always enjoy reading what position you guys are buying too as well in the comments below these videos. So don't be afraid to share what stocks you like either. And so like I said, it's been a huge week, starting with DeepSeek, which absolutely whacked Nvidia, down almost 17% on Monday. It's pretty much just boxed up here the whole week. Market's still not really sure what to make of all this. Bonds also started the week by gapping up. We heard from the Fed on Wednesday, but they too just boxing up here. Heard from mega cap tech Meta, knocking it out of the park. Really great numbers. Zuckerberg reiterating huge plans for CapEx, AI build out. Same deal with Tesla, even though missed on numbers. Market's really excited by the future. I know most people online are obsessing over the PE of 100, as they think stocks should only be valued on what a company made in the last 12 months. However, as a long-term Tesla shareholder, I think the next couple of years look more exciting than they've ever done. So I'm not really surprised to see a huge multiple on the stock at the moment, especially in this growth-led market as well. And so if Tesla did have a PE of 30, I would consider that really cheap and would be adding to my long-term position. And if we were to dip down below 300 this year, I probably will pick up a few more shares. And just going through my themes watch list, a little spotty out there today. Did get Lightbridge breakout again, still getting a lot of action in the quantum and small modular reactor, nuclear related stocks, with others as well like Rigetti, but they've had such a huge run this last couple of months. A lot of the trade might have already been had, but I still think robotics could be next for the market to get excited about, along with AI still having legs left in it, like that stock I gave to you guys yesterday, Recall Systems. Even in a weak tape today, up almost 11%. They're involved in artificial intelligence for roadways. And so I still think there's plenty of potential left in the AI trade, the whole leading theme of this bull market. And in fact, the next stock I'll be investing in this Monday as part of my stock picks portfolio is involved in both robotics and AI, what I think is an undiscovered gem. There's a small cap, still valued around 400 million. I think it has huge potential this year. So anybody wants to get my deep dive report into their inbox this Sunday morning on which stock I'm going to buy next, then click the link below this video and check out my stock picks portfolio service, which you can follow in real time. It's up over 40% in time-weighted returns since I started it in June last year. And that's thanks to some winning positions I've got in there like Hims and Hers Health, which is now up over 120% since I first bought it last year in the 15s. And this is another theme I think could play out in the market this year. AI healthcare, personalized healthcare, and stocks to do with addressing cancer have been doing well of lately, ever since Larry Ellison spoke of it at the Stargate announcement. Seen some others today, like Cellus Life Sciences, have a pretty good rally, and Immune Bio has been on a strong tear this last month. They're also involved in the fight against cancer. But like I said, stick with me today, and later on in this video, I'll show you the other stock that I sold a put option on today that I don't mind taking a position on, something I haven't mentioned here before. I think you guys will find interesting. But first, let's just go over a few of today's events and what people are talking about. Nvidia really in the crosshairs now, both in the market and politically, after this DeepSeek kind of freak out to start the week, as they basically released a chatbot on par with GPT, also making it open source, and apparently for a fraction of a cost. However, like we said right from the start, that's unlikely to be true, but nonetheless, they did demonstrate a good level of optimization and capability. basically making the chips more efficient, for which the market understandably got a bit uncertain on Nvidia and still is. But overall, we think it's a net benefit because it just lowers the cost of AI and helps other companies who want to use it, even though it very well could compress margins on Nvidia, maybe slow down their crazy growth somewhat, but that'll be counteracted with more volume growth. But like I said, it is a political football now. We're getting news that Nvidia's Singapore business has been exploding, now accounting for over a fifth of revenue. Tiny little island country importing all these chips. Are they really just staying in Singapore? Or they may be smuggled through China. There's basically Singapore and China connected at the hip. A lot of Chinese-speaking people in Singapore, that it shouldn't be that surprising to know that's what's happened. So anyway, apparently Jensen Huang has met with Trump today for them to discuss US AI policy. How are they going to approach all this? Wanting to make US the AI leader, but at the same time, not helping their biggest competitor. Very complex relationship, as a lot of American companies rely on China, not only for production, but for revenue. And so there is a bit of a conflict of interest at the business and political levels. And no doubt Jensen Huang could face pressure as to whether he's allowing his advanced AI chips to be sold through backdoors to China. And just putting a 200-day moving average on Nvidia, that's the first time in a couple of years it's not only breached the 200-day, but we actually finished the week below it. So that's technically a bearish signal. Doesn't mean it's going to come crashing down right away, but more a sign this upward momentum could very well be stalling out, just as it has been for the last couple of quarters, in fact. And so we very well could see a lot more volatility in Nvidia and the chips in general. Back and forth, back and forth. Questions around DeepSeek and selling to China. Not to mention it's just been on such a great run for the last few years. Definitely could be the first phase of the AI boom. I don't want to say over, but maybe the best of it's already been had. And we're now moving on to that second phase, AI agents, physical AI, and the companies that can actually benefit from cheaper computing power and better output from these GPUs. That's why I continue to believe this DeepSeek thing is a net benefit, maybe just not to Nvidia. Or Taiwan Semi as well. It's also in the political crosshairs. They are looking to diversify around the world, building plants, Japan, Europe, also in Arizona. But along with tariffs, this could keep a bit of uncertainty and a little bit of volatility in the markets, at least for the next few weeks, until things might calm down. But like I said, we're already getting reports from semiconductor analysts showing DeepSeek actually spent over $1 billion on its compute cluster. That's $6 million that was thrown around by the media on Monday. Like I said, was ridiculous to begin with, especially coming out of China. But nonetheless, it revved the bears up, started dropping the R word again, the one they've really been hoping for the last 2 years. Are we going to get it this year? Keep in mind, recessions becoming more and more of a rarity in modern markets. We've only really seen 2 decent recessions so far this century. We're now a quarter away through the century. Early 2000s and the GFC '08. Technically, yes, and COVID, but that was more a blip on the charts than a real recession. Economy and market was so cashed up, stocks actually exploded in 2020. But there are plenty of people that still think we are on the cusp of a recession, including hedge funds, macro funds. They've really reduced their exposure to US equities over the last few months, starting off the new year here, down near the bottom of the range of their exposure. However, just because they're hedge funds doesn't mean they always get it right. And generally when we see crowding by any players in the market, it's just vulnerable to go the other way. I'm pretty sure there's algos out there that look at exactly that, crowded positioning, and then use the slightest negative news to enact a rug pull. After they've slowly built a position up in the market, they then slam the tape with massive orders, causing an unwinding because they know everyone's leaning to one side. And so the last time we saw macro hedge funds this low exposure to equities was actually at the start of this bull market, late 22. Prior to that, in March 20, was a great time to buy stocks. In the scare of late 18, August 2015, I remember that one as well. Big unwinding in hedge funds. And of course, the Eurozone crisis, 2010, 2011. And so again, we'll just have to wait and see whether this time is different. But another big fundamental driver helping to power this market, companies buying back their own shares. Well, the crypto bros love the fact that Bitcoin is finite, only ever be 21 million coins, even though there's infinite amount of other coins. People forget a lot of these big companies, they have decreasing supply. They have deflation in the amount of shares. Corporate profitability never been as high. That's why we're on track to potentially do maybe $1.25 trillion worth of buybacks this year. That's over $4.5 billion every day being plowed back into the market, depleting the number of shares by companies. Not to mention everyone's pensions funds doing the same thing. And some of the biggest stocks in the market are holding up well, even though we've got volatility in Nvidia. We just heard from Apple. And again, they didn't give the best numbers, actually showing sales dropped in China, but the market shrugged it off pretty good. And like Dan Ives says, he's got a $325 price target on the stock because he believes they're on a path for a $4 trillion market cap this year, as he thinks the consumer AI revolution has to go through Apple, which he does have a point. Apple doesn't need to waste capex on creating all these technologies. It just sits back and lets everyone else do it, packages it all together on the most favorable terms, slaps their logo on it, and can sell it for pretty much whatever price they want, and instead use all their excess cash to send back to shareholders in the form of dividends and corporate buybacks. Stock actually gapped up today after earnings, although it was a bit of a reversal candle there. Still not that far off all-time highs, as the market's still thinking a new upgrade cycle is going to get it back into healthy double-digit growth. And let's not forget the stock everybody loves to hate, Tesla. Bears still convinced it's just an EV company, willfully ignorant to the explosive growth in services, energy, battery storage. And next up, robotics, not to mention cybercabs. Market's forward-looking, and like I said, the future's never looked more bright for Tesla. And I wouldn't be surprised in our lifetimes, and who knows, maybe closer than what we think, when you go to the dentist, you may actually just see a Tesla product there, with a robot cleaning your teeth. And I know the prospect of AI robotics world scares a lot of people. However, let's see how scared they are when you can get the job done for half the normal cost. And so we are going into a world that will be largely powered by AI and robotics. Slowly but surely, this is a secular trend that's not only going to play out in the coming years, but the coming decades. And like I said, I believe Tesla's already leading that with automation, AI, and robotics. Optimus Bot has already gone into production. Let's move on to commodities. You can see a bit of volatility in these markets as well over the coming weeks. On the back of tariffs, did see a lot of volatility in the uranium nuclear trade on the back of DeepSeek, which I think is more overblown than it was for the chips. I think for sure the chips deserve to come off somewhat. But uranium, I don't think the whole bull thesis for that relies on a cheap knockoff coming out of China. And some of these stocks have actually bounced back quite sharply. Oklo got slammed down on Monday, actually spent the rest of the week filling that gap and completely recovering. Almost the same for nanonuclear, and not quite for NuScale, but Lightbridge actually finished up on the week. But some uranium producers still a bit under pressure. Cameco there. And just moving on to inflation, we got PCE today coming in line as expected. Annualized rate 2.6%, with it kind of just bumping around now. Stalling out, still somewhat on the right track, but also signs it could be bottoming out as well. No surprise to see the Fed in wait and see mode. And there's a look at the 1 year PCE annual change. Has definitely ticked up ever since September. Still hasn't taken out yearly highs of March last year, 281, but just going out to a 3-year chart. There it is, kind of stalling out, basing out, 5-year chart, and finally a 10-year chart. That's a good visualization of inflation. It's really come off those peaks, but is it finding kind of a new normal here? Mid-high twos. It's definitely looking a little different than what we're normally used to prior to COVID. But market was a little mixed. Fed fund futures somewhat encouraged, actually increasing the probabilities the Fed could maybe cut in March or May. Still heavy odds they'll stay on hold until mid-year. Otherwise, the market is still looking for the Fed to do another cut or two. So any surprises on the upside of inflation would flip the narrative on the path of interest rates. That too could cause a bit more volatility in markets. And just looking at bond yields, 2-year flat again, 420, a little bit of a bump up, not too much in the 10-year, 454. Looks like bond yields could be in wait and see mode as well. And since next week is the first week of the new month, we get jobs report on Friday, non-farm payrolls. US economy expected to have generated 170,000 new jobs for the month of January. Unemployment rate expected to come in at 4.1. Also get consumer sentiment next Friday as well. So that'll be the key economic data markets will be looking at next week. We also get a few Fed speakers, PMIs, and a look at inflation in the Eurozone. But we just completed the first month of 2025. S&P 500 finished up 2.6%. Not a bad start to the year, even though we're a little soft here going into the weekend. There's a look at the weekly heat map. You can see semis did actually finish the week quite soft there, along with Microsoft and Oracle as well, but wasn't broad-based selling in mega cap tech. Apple and Meta actually had good weeks. Bit of a bounce back in healthcare. Financials holding up. Energy a bit soft, while the consumer defensives also catching a bid this week. And since we just put in a greater than 2% performance for January, looking back in history, that typically bodes well for the rest of the year. On average, the final 11 months will give us a 12.3% return, and the entire year will finish up 87.5% of the time. How January goes the year. Old saying in the market. We'll see whether that holds true for 2025. Like I said, no doubt we'll have our volatility episodes. I think the underlying fundamentals are still there, and in fact, I think we've got the potential for markets to really rip on the upside, especially in some areas like robotics and other AI-related stocks. We're also coming into a seasonally bullish period for equity flows coming into the market back the first half of February. A lot of money can pile into the market before peaking out going into the second half. And that actually coincides with seasonality as well. Looking at typical returns for February in the S&P, can consolidate, rally somewhat into mid-month for also turning over a bit. And I wouldn't be surprised to see that for the month of February. We've got tariffs, China, Nvidia, plenty for the market to still be uncertain about. See how that jobs report comes in on Friday. Might get potential new tariff announcements on Europe, the rest of the world, What's China going to do back? And of course, valuation, still ever present on a lot of investors' minds. As we constantly get reminded, the forward PE on the S&P 500 is at 22. However, you got to put that in context. It's not just this squiggly line on the chart here is all that matters. People get carried away and end up overanalyzing the noise instead of the underlying drivers and putting it into context. So we were high back in 2020, but that was more a liquidity-driven, sentiment-driven rally. But this one's been more based on fundamentals, earnings growth, rather than the market just getting super excited. And so like I said, when it comes to stocks and the market, it's forward-looking. Market's more concerned with the next 12 months than the prior 12 months. And so when it comes to these valuations, you got to ask yourself, does the earnings growth in the coming years, does that look better than what we're normally used to over the last decade? My answer to that is yes. Already got the huge momentum there. And at the end of the day, a forward PE of 22, if you express that as an earnings yield, that actually works out to be 4.54% forward earnings yield on the S&P 500. Funny enough, that's exactly where the 10-year yield is right today, 4.54. So as an investor, you always have an option what to do with your money or new money coming into you, savings. Where do you invest it? You can lend it to the US government for 10 years and they'll promise to pay you 4.54% in yield. At the end of that 10 years, you'll get your principal back. Now, if there's been a lot of inflation in that 10 years, your 10,000, 100,000 or whatever you've invested won't have the same purchasing power that it did today. Or you could put it in stocks and a very similar yield and you own a piece of a business. And if those businesses have pricing power, they can raise their prices with inflation, which also protects your wealth from the negative effects of inflation. As always, the choice is yours, but just remember when it comes to investing, everything is relative. And finally, as promised earlier in this video, thought I'd share with you guys today the other stock I sold a cash secured put on today, and that is Zim Integrated Shipping. Ticker symbol ZIM. I'm sure some of you have heard about this stock before. It's been hugely volatile, exploded with shipping rates after COVID, also came off really hard as shipping rates did as well. Stock is somewhat stabilized, maybe potentially based out on huge accumulation, and it's pulled back the last couple of months. The market's been thinking a lot of these geopolitical tensions are going to cool down, and with it, shipping rates, all the big channels in the world could soon open up. But we just heard from Trump, who's been threatening to try and take back the Panama Canal and rename it like he did the Gulf of Mexico. Says China's been illegally operating it. States originally built it. It's an 82-kilometer artificial waterway that connects the Pacific and Atlantic Oceans. Real key shipping route. So who knows? We could see a bit of a showdown between the States and China there. That would cause some volatility in shipping rates. And unlike other shippers like Maersk and big global giants, Zim don't have fixed contracts. They sell at the spot price, which is more volatile, so they could benefit from another big jump in shipping rates. And just looking at the dry bulk shipping ETF itself, it too's been coming off really hard this last year, but big signs of technical accumulation here. That and Zim is still ridiculously undervalued in my opinion. My stock fair value indicator has an 83% undervalued. $2 billion market cap, company still does over $7 billion trailing 12-month revenue. Monster dividend yield, but no doubt their cash flow and stock price is super volatile. But just like Intel, this is a great stock in my opinion for the wheel strategy, which I sold the 18 put strike on today that expires in next month's regular OPEX, third Friday of the month, 21st of Feb. And so this stock also has active options with plenty of juice. In fact, implied volatility around 65%. That sets up for a good return on margin. And so this is a stock that's not really suitable for my stock picks, as I typically invest in small caps that have huge potential. It's not really a stock I'd look at for a dip buy, which is typically quality large caps and uptrends. And this is not really a stock I want to own for the long term either, as I typically only want to own strong brands. However, this is a stock that could continue to range, and I think that it's good value. I don't mind owning at $18 a share, and it also has a high dividend yield, so I get paid 3 times. Premium I collect from the short put, the dividend yield while I hold the stock, and then if the stock trades back up to the top of its range, I'll write a covered call, maybe somewhere between 22 and 24 ideally, and keep doing that until the stock gets called away from my account. But of course, it doesn't always go your way. It could very well break down through support. But like I said, I don't mind owning the stock potentially for a few months the rest of the year. I'll just keep overriding on it until it gets called away. And so like I said, that's the option wheel strategy. And going forward, I'll share a few more of some of these trades I take from time to time, as I know a lot of you guys are interested in options. I often get asked about it. So I thought today I'd share 2 trades I took on Intel and Zim. And so if you haven't already, subscribe to this channel and I'll let you know how these trades pan out. Other than that, that's pretty much a wrap for the week and the daily market review. Thanks very much for sticking with Click Capital. Have a relaxing weekend after this big week in the markets, and we'll see what next week brings us. That's all for today, and I'll see you guys again come Monday night. Cheers.